There are 1,000 ICT YouTube videos online right now. And yes, some of them may work, but a lot of them have been created by people who do not even make a living from trading. And that's the difference here. I'm Callan, an official GOAT funded trader partner, and I actively trade funded accounts using ICT concepts with my own execution model. I'm currently managing multiple funded accounts, including a $100,000 GOAT funded trader account, which I'm getting paid out consistently month after month. In this video, I am not giving you theory or recycled concepts. I am showing you the exact ICT concepts which I implement into the real market conditions on a daily basis to make profitable trades. I'll be showing you the exact process which I follow with real live trade examples. ICT is powerful, but it is also one of the most misunderstood and difficult approaches to learn properly. It takes time, plenty of screen time, and a lot of trial and error. What I'm giving you here is the structured framework which took me from confusion to consistency. After watching, your job is simple. Go onto TradingView, into replay mode, backtest it, and rewatch the video as many times as you need until this process becomes second nature. If you get value from this, drop a comment of the strategy you are currently using and subscribe. We're consistently sharing real practical trading education here at GOAT Funded Trader. Now let's dive straight into it. You've probably tried ICT concepts, FVGs, OTEs, and still getting chopped. The problem isn't ICT, it's sequencing. I'll show you the exact order of my operations. So here you can see we have my 7-rule ICT routine. As you can see, number 1 is define the external range. Number 2 is the liquidity story. Number 3 is session plus timing. Number 4 is entry models. And number 5 is a risk plan. We will be going through each rule individually with charts. As you can see, we have number 1, which is define the external range. Use prior day high or low, Asia high or low, or daily swing range. And ask yourself, are we hunting the external liquidity above or below? So as you can see on this example here, we have a daily swing high and a daily swing low, which has allowed us to identify our current trading range on the daily time frame. And we can see that price has actually been drawn into the OTE area of this trading range. So what you've now got to ask yourself is, where will price be drawn to from this level? Will it be drawn onto the upside to this daily swing high, or will it be more drawn to the daily swing low? The second rule is the liquidity story. We identify resting liquidity, equal highs or equal lows, or clean swing points, and we expect to run on stops before a real move begins, which is also known as the purge. So as you can see on this example, we have some equal lows which have just been ran, mitigated into a fair value gap, and we have some equal highs left above. So we could ask ourselves, are these equal highs now our next draw on liquidity because we've took the equal lows? Number 3 is entry model. So we use the M1 to M5 and we look for a partial fair value gap fill aligned with a market structure shift. And you can also use the OTE confluence if it aligns with the FVG and market structure shift. So as you can see on this example here, we have a sweep of Asia lows giving us a 5-minute break of structure. We then expand onto the upside, giving us a 5-minute market structure shift as we have now shifted bullish. And then we've seen a nice retracement into the fair value gap, which caused that market structure shift, which also aligns with the OTE. And as you can see, price rockets onto the upside from there, targeting the opposing end of that liquidity, which is the Asia range high. So as you can see, we have actually got a lower time frame entry model. So as you can see, this is a very ideal lower time frame entry model for us to use. And finally, our next rule is having a risk plan. So we have a fixed risk of 0.5 to 1% with our stops below the invalidation swing. As you can see, our stop loss is just below this low, which actually caused the market structure shift. So this is our 5-minute swing low, which would be anticipating to be a strong low. And this would be our entry point at the open of the fair value gap / price displacement, and would be only risking 0.5 or 1% of our account balance per trade. And this is the exact risk plan you want to follow trading your prop firm accounts, as this will keep you consistent in the long run. And then again, targeting the opposing end of the liquidity. So in this case, it was the Asia range highs. But we can also leave it to run to higher time frame levels if the price action supports it. As you can see, we are now on TradingView on a live chart example, and I'll be showing you the exact lower time frame entry model using real-time data. So as you can see at the timestamp at the bottom of my chart, it is Tuesday the 18th of November when I executed this trade, and I will actually show a screenshot of the trade profit so you can actually see I took this on my own account. So we are going through the lower time frame entry model now. So as you can see, as the London session opens, we get a sweep of Asia lows. So we swept a ton of liquidity and a very significant point of liquidity, time-based liquidity, and we've actually now got Asia range highs left above to be drawn onto the upside. And what we can see is as the London session opens, we get that volume, we get that injection of buys being injected into the market. So we can see that institutional orders are now present in the market and we want to trade alongside the volume. So again, if you haven't watched the previous video, make sure to go and watch the previous video as we do dig deep into volume and actual time cross pricing, which is very important in trading. This means that I only trade specific trade sessions, and I only specifically trade the London session or the New York session, as typically they have the most amount of volume being injected into the market. So as you can see, once we got this injection of buys into the market, that actually caused our 5-minute lower high, as this is a 5-minute lower high here, as we can see, to actually be invalidated as we've closed above it, giving us a market structure shift, as you can see an MSS here. And if we just make that a bit bigger so you can see the actual thing, MSS. And after this market structure shift, this then confirmed a long entry from this demand zone, and our target would be the opposing end of the liquidity, which would be Asia range highs. Now our only job is to identify an entry point. So as you can see, we have this order block, which we could refine our entry to, but the issue is refining entries to one specific lower time frame order block is you can be trying to be too perfect, which can cause you to miss the actual entry in the end. So this is why I would actually refine this entry point to the actual price displacement, which is the fair value gap, also known as imbalances. And the actual technical explanation for it is an inefficient price zone. So this is an inefficient price zone, which now needs to be made efficient. So that's the process happening at fair value gaps. When the market has a large move onto the upside, there was no access for liquidity on the other end, so for sellers, which creates an inefficient price zone, which is why the market needs to come back to this inefficient price zone to make it efficient again, to make the market a fair environment for both buyers and sellers. So this is why I would prefer to use this fair value gap, as there's an actual transaction happening at these levels. There's an actual process occurring. And again, the market has no specific rule to go and target a refined order block. I mean, order blocks do work, but refining them to just one, sometimes you can actually miss the entry. So I like to just use fair value gaps in this case, as I know the market actually needs to come to this area. Whereas with the order block, there's no need for the market to come to that very specific area. So my entry will be at the open of the fair value gap, and my target would be at Asia range highs, with my stops just below the invalidation swing, which is the 5-minute swing low, as it caused the 5-minute market structure shift, which means this 5-minute low is a strong low. And then also we can use the OTE, our Fibonacci retracement, as we've now got a new lower time frame trading range. So when we got this market structure shift, the 5-minute trading range actually shifted from this high to this low to now this low to this high, as we now have a bullish trading range. And as you can see, our entry point aligns with the OTE within the fair value gap, and this is a perfect textbook entry for us to take. So we'll just play price now so you can see how the trade actually played out. And as you can see, it achieved take profit within 2 hours. So using this exact process, we would have banked 4% within 2 hours during the London trading session. So before even New York had begun, we were done for the day using this process. So we'll now run through some failures which you will need to avoid. So trading the middle of daily ranges, guessing direction without defining a range, trading the first touch of liquidity without a market structure shift, and breaking rules after a loss. Revenge kills funded accounts. So we'll go through these individually. And number one, trading the middle of daily ranges. We just simply don't do this, as price tends to accumulate in the middle of the market, and we do not want to be trading during accumulation phases. We only want to be trading during the expansion phase. So therefore, when the market is in the middle of a range, we don't trade. Number two is guessing the direction without defining a range. So just because we see a bullish candle being printed here does not mean that the market is now ready to go above and target this high, as we have not identified our trading range. So therefore, we do not understand our levels of premium and our levels of discount. And number three is breaking rules after a loss, which is revenge trading. So if you hit a loss and you hit your overall personal daily drawdown level for the day, then you should walk away from the market and not continue to overtrade just to destroy the account. As you can see, we have a real dashboard here from GFT from an account which I failed a long time ago, and it was due to the fact I was overtrading. As you can see, I had 6 trades in one day on the 19th here. I had 3 trades the next day, 2 trades the next day, all resulting in over 1%. Well, in fact, this was a 50k account, so they were resulting in 2% plus losses each day. So as you can see, this was like 2.3% loss, this was 2.5%, and then this one was actually 4% loss overall. So we actually blew the account. So over trading actually destroyed this account in the end, even though I was in profit on it. This routine keeps you in prop firm drawdown limits, giving you a clean, slow equity curve, controlled losses and larger just session driven wins. It may seem boring, but that's why it works. If this breakdown helped you understand ICT in a more practical real world way, don't just stop here. Go onto the charts and implement what you've learned. Mark up your zones, practice the lower time frame execution model, and begin programming the process into your mind. Building screen time and actually practicing what you've learned is going to turn that knowledge into an actual skill set. If you found value in this video, make sure to drop a like and a subscribe, because we're consistently sharing trading education, trading strategies which are actually being used on real funded accounts. Drop a comment below and let me know what part of ICT you are struggling with the most, or what strategy you are currently working on. I take the time to read every comment and reply, and I will also be using these to help shape the next videos. And if you want to see more live breakdowns and deeper strategy lessons, then make sure to check out the next video here on the GFT channel. I'll see you in the next one.